Hi, thanks for joining me again. On the chart in front of you, where would you place a line? I'll give you a sec to think about it. This bar here has quite strong volume. You can notice that the spread has narrowed considerably over the previous bar, which was a breakdown bar. Now, this bar itself, this bar here, has all the textbook qualities of stopping volume. Stopping volume says that enough volume has been drawn out in the market to stop a downtrend and knock price sideways. And I think this bar here is probably a very good example of that. The very next bar was a lovely test bar and supply was low. That allowed price to go up for a couple of bars before coming back to consolidate and check at the lows of the stopping volume bar. Spread narrowed considerably, but volume was again high. That suggests strong buying came in. The bar couldn't be that narrow on that amount of volume unless strong buying came into the market. And that buying was confirmed with two up bars. Now, if you look carefully, price initially traded lower than the previous close. That was probably some testing just in there at the opening of that bar before price then pushed away and volume was reduced back to just a little below average. Now, price then moved up into the trading range here, and you could mark that as the highs of the trading range, or you could mark the breakdown bar as the highs of the trading range. I would generally look at marking the highs of the trading range, but you can see there's both. They're both legitimate lines, which will mark the highs of the trading range. You could have initially marked this bar here if you wanted to, but you would have soon seen that price wasn't respecting that line. And it's quite okay to adjust a line or fine-tune its placement if you can see that its initial placement perhaps wasn't correct. So we have buying on this bar and this bar. Price pushes up. It goes through this process of whipsawing up and down. And that's because there will be holders stuck back over here and higher who are in a weak position. Is someone who, if they sell today, would make a loss. They're in a weak position in the market. And this up-down motion where price pushes higher and then lower, higher and then lower, is a way of encouraging these people to take a loss so that one day when price breaks out, the markup doesn't have to absorb their supply, and it also allows for some accumulation in this trading range. Now, this bar here was most likely a buy the offer bar, where some holders, perhaps stale holders over here, saw price right down at the lows of the trading range. This is what's called the demand line of the trading range. This is known as the supply line of the trading range. The demand line is where previous demand has come in and you expect it to come in again, like it did here and here. And this is the supply line, where resistance is expected from that line and above. You can see that the market pushes off that line, but never really challenges it seriously, because there's likely to be supply up here, and it'll take a big effort for the market to break out. That's why when you see breakouts, they're generally on increased volume and with wide spreads. So this bar here was likely a buy the offer bar, and as price was coming down in this little phase here, there was some people probably who decided they weren't going to sell at the lows, but they placed their sells just above, hoping that if the market pops up, then they get out for a little bit better price than what it was looking like. And when the offer has built up substantially, a way of accumulating some more stock is to buy the offer, and quickly, over a relatively short period of time, the active traders in the market can buy the offer right up to the top. But then they're not interested in going higher, whereas that might attract some of the short-term and day traders who then are hoping that price is going to break out and push higher. But at this point of time, at least, that doesn't happen. Now, the question is, following the buy the offer bar, is there anything that might tell you that price was not going to break out and instead price will break down? It's obvious, we're not hiding it. Price didn't break out of this trading range. Instead, price broke down and the weakness continued. Was there any telltale sign of the price breakdown to come? If you want to pause the video, you can. Always look for an increase in volume, and volume and spread should generally correlate. High volume, wide spread, like this. But what happened here? High volume, narrow spread. That's an anomaly. That's when you should think carefully about what's happened in the market. And what has happened is high volume's been drawn out, and it should have had a wide spread, but it didn't, and it didn't have a wide spread because there was lots of selling, pushing price back down. As the buyers were stepping up, they were being satisfied by whoever was selling. Most likely whoever was buying over here and bought over here. For whatever reason, sentiment changed. Perhaps there was an announcement and it was being interpreted as a good news announcement, and that created the demand. But what was considered a good news announcement wasn't by the buyers. I don't know. It doesn't really matter. All that matters is strong selling came out of the market and it was forcing price back down, and that kept the spread very narrow on what is the highest volume so far on the chart. And to confirm the weakness in the market, it didn't go up the next day, it went down and closed lower. And 2 days later, price broke down, and it was confirmed the day after that with a further down bar. If you were in the market, you should have been very suspicious on this bar. And if you stayed in when this breakdown bar occurred, you should have been looking for your way out. It was unlikely price was going to survive. Even if it turned around and made an attempt to get back in the market, anyone else who was stuck in the market over here would have used that to get out themselves, and that would have forced price lower. So it was highly unlikely after that happened that the market was going to recover. It was going to be a big ask if it was going to recover, and generally that doesn't happen in the market. Something happened and the buyers wanted to get out, or someone wanted to get out. I'm suggesting it's the buyers because if it wasn't, then the market would have likely done this, a widespread down bar, because if someone else was getting out here, the people who had bought over here strongly and any other buying that went on over here would have had to dump their shares because they can read the market and they would have known what happened. If they weren't dumping on this bar and they were caught out, they would have just dumped it all on the breakdown bar. And that would have caused a widespread down bar on really high volume. But that didn't happen. Price broke down, but broke down relatively gently considering, and that was probably because those who were in mostly, if not completely, got out on this bar for whatever reason. It doesn't matter what the reason is. All that matters is that there was massive selling on this bar, and that massive selling caused price to eventually break down and then continue lower. So hopefully that makes sense and you understand that a narrow spread up bar can only form like that on really high volume if there's really strong selling pushing the price down and satisfying any of the buyers. And that selling pressure, downward selling pressure, keeps the spread narrow despite the volume being really high, because otherwise it would have been like this bar. High volume, wide spread, just what you expect. And this one here was a little bit of an anomaly, and that's why we liked it, because spread narrowed as price came lower, but the volume was increased, so there was an anomaly there, but it was a buying anomaly. Tom Williams would always say, when strength is first seen in the market, it'll be seen on a down bar, and that's generally the case. And when weakness is first seen in the market, it'll be seen on an up bar. That's why you're always got to be wary of widespread up bars, especially at the end of a long uptrend. This price here was in a downtrend, and then we saw spread narrow, volume increase, price closed off its lows, a low volume test, and then a push higher. That always suggested buying in the market, and then price came back down and saw much more buying here. So when strength is initially seen in the market, it will generally be seen on a down bar. And when weakness is first seen in the market, it will generally be seen on an up bar. And this sort of bar here, the buy the offer bar, is like an inverse accumulation bar, an upside down accumulation bar. And that occurs because there's still more stock wanted, but no more is being drawn out. You can see down here that volumes are reducing, and that's because there's not very much supply left, but the buyers still wanted more stock at that point. So the best way they can accumulate stock without pushing price against themselves is to produce a buy the offer bar, where they buy the complete offer in one great big buying bar over perhaps an hour or so, if it's a daily bar. And they just push it up and they take out these price levels over and over and over and over again, and they get to accumulate a large amount of stock without pushing price against themselves too much. This would have been in preparation for a future breakout, like up here, say. And for whatever reason, sentiment changed and price was dumped into this narrow spread up bar on very high volume. Okay, that's my lot. Hopefully that was worthwhile. Thanks for joining me. See ya.